Welcome back. Now in this lecture, we'll look at an example of using this pattern in analysis of dollar index. Now dollar index essentially represents the value of dollar against other currencies. In December of 2015, the Federal Reserve decided to lift interest rates after a prolonged period of accommodative policy stance. Now a fundamental question to answer is what should happen to the value of dollar if the Federal Reserve increases rates? Since the interest rates are going up, it should of course yield to an increase in value of the dollar against other currencies, and hence the dollar index can be expected to go up if one were to only look at the fundamental factors. Now this is a chart of dollar index. This chart was issued by us to our subscribers in December. Now this, as you see, is an ending diagonal pattern. It is broken into 5 waves, with each of the 5 waves divided into an ABC pattern. The pattern though hasn't yet given the confirmation signal, which, as you will remember, would only come after the prices breaks through the lower trend line L2, which is essentially the line joining the points 2 and 4. Once the confirmation occurs, we would expect the prices to fall towards the start of wave 1. So ultimately this pattern was signaling that the dollar index is likely to fall. So while a rate hike was widely expected and fundamentally this would mean the value of dollar should rise, this pattern is signaling the complete opposite. So now the question is, between the fight of fundamentals and technicals, who really won? Now this is the chart immediately after the Federal Reserve's decision to hike rates. As you can see, the prices continued to trade in a converging price range between two trend lines until markets gave a confirmation signal. Once the confirmation signal was given, things escalated pretty quickly. The price move was so violent that in fact the prices fell even below the target zone for the pattern. As you start using this pattern, you will find often it is the case that fundamentals and technicals point to diametrically opposite directions. In such cases, my recommendation to you is that you stick to what the technicals are saying, but at the same time, you should strictly observe the stop loss associated with this pattern. Now that we have seen the application of this pattern to currencies, in the next lecture I am going to see how this pattern worked very well in an emerging market index. So see you in the next lecture.